Good afternoon. Thank you to the organizers of ZEST for having me here. The last time I was actually in Malta was 8 years ago, when you still had those yellow and white buses going around the island, which was a lot of fun. I'm actually here to talk to you on another level and to carry on from what Julie so nicely started. She started talking about the ecosystem in which venture capital funds operate. I'm going to talk about how venture capital firms have been constructed, what's happening right now, the trends that are affecting them, and what the future might look like for the industry. Here's a little bit about me. I actually work for a fund based in Berlin. It's actually a multi-fund investor. We have 6 funds, 3 early stage, 1 growth, and 2 buyout funds. We invest anything from 100,000 euros to 100 million euros. I've had a really varied background. I've had financial experience, operational experience, and now I am very fortunate to be sitting on the other side of the table. So I'm going to start by asking you, how many of you actually understand how a venture capital firm is set up? Okay. Very few hands in the room, so that's good. Okay, so a traditional venture capital fund is, and this is the model that's been around pretty much since the 1960s, has 2 levels in it. The first is the partners level. The general partners are the ones that make the investment decisions in the firm. You sometimes might see someone who's a venture partner. This is someone who's responsible for going out and sourcing deals, and they're not with the firm for a very long time. The other part of the firm is actually the non-partners. These non-partners are the principals, the associates, and the analysts that either that go out and source deals and help with the partners with the entire process of making the investments. So actually, there's not much difference between partners in a venture capital fund and entrepreneurs, because once upon a time, a partner of a venture capital firm had to go out and raise capital in order to start investing. And they went out to limited partners, and there are a range of limited partners that we have. They're corporates, they're endowment funds, they're private individuals. And these partners have to be, these limited partners have to be convinced about the strategy that the general partners are introducing so that they can make those investments, invest in the fund, and the GPs can make those investments. So why would I, as a limited partner, give my money to a general partner? Well, there must be some value that needs to be added there. And the value that general partners are pitching is that we take risks, we have a different risk profile to you, we have the brand and the reputation in order to entice entrepreneurs and make those investments. And then we have the partner experience of actually having started and run companies in order to make sure that the companies that we invest in are successful enough and go on to exit. One of the most important things is also the network that a partner has pretty much built up over the time and lifetime of that fund. So how does a VC make money? This might be pretty surprising. You may have heard of something called the 2+20. The 2+20, the 2% is actually the management fee that a venture capitalist takes, and the 20% is something called carry, which is the net return, share of the net return that the fund makes. So once you've returned the fund, any additional money that you make, you basically take 20% of that. Just to put that in context, I've got an example here. 100 million fund, you would pay 20 million euros in fees over a 10-year term, so that there's only 80 million left to invest. So you might understand why venture capitalists had pretty much a little bit of a bad name in the last 20 years or so about VCs earning money without really making money for their limited partners. The other thing about what we do in a venture capital firm, 70% is pretty much relationship management. We do a lot of work with our portfolio companies. This might seem surprising, but typically we spend very little time actually making the investment. Making the investment is actually the easiest part of the entire journey. Spending time with the entrepreneurs and taking them along the ride, that's the bit that takes the most effort. In terms of returning the fund, we pretty much have to have just one winner. We don't need so many winners in order to make money back for all of our limited partners. So you might be wondering, what kind of traditional funds are there out there? These are a range of them. They've been around for decades, and this is the thing with traditional venture capital funds. They basically go out, they raise capital, and then if they're successful, they then do it again, and they might have their second, third, fourth vintage of fund. Every time they raise a fund, the amount that they raise typically goes up. So over a period of time, you have the likes of something like Accel Partners, which has been around for maybe 3 decades, having a $500 million fund. So what does this really mean? What it means is that the traditional model of venture capital is pretty much unscalable beyond just what the time that the partners have. And there's a consequence to that, because tell me an industry, any industry, where a business model doesn't need to adapt over time, even when the market changed. So what's changed? What's changed is actually that it's easier to start companies than it's ever been before. The internet is only 20 years old. We now are more connected than we've ever been before. The price of hardware is reducing. You're all probably aware of Moore's law, which means that the size of the transistors is falling, and then they have double the speed of which they're operating. We have more tools and services than we've ever had before in order to build companies. You have AWS, Amazon Web Services, where things can be hosted in the cloud. It's much cheaper than ever before to use resources such as Google AdWords or Facebook, which basically centralize your consumer bases so that you can get access to users far easier than you had to 5 or 10 years ago. And the final thing, which I think is actually incredible, is what the internet has enabled, which is the democratization of information. You're now able to read what venture capitalists are saying on Medium. You have access to their thought processes. You can engage with other entrepreneurs on Eventbrite. You can learn about technical skills on General Assembly. And you can even find the source code for other people's companies on GitHub, which means that you're able for the first time to build faster, quicker, better than you've ever been able to do before. And what that means is that when the price of building a company falls, it means that there's so many more companies that can be built. So what impact is this having on the venture capital community? It's having a profound impact. As you can see here with the historical VC, this was the traditional model that I explained in the very beginning. You in fact didn't have to invest, or you rarely invested at the seed stage. You typically invested at the Series A. Then partners being entrepreneurs saw an opportunity in the market. So they created institutional seed funds and went earlier in the funding curve. And then, as we've seen in the last 5 years, we've had a fragmentation of the seed. Seeds now, because you have a pre-seed, you have a seed, you have a seed 2, and actually you have far more players in the seed market because the institutional investors are investing later. They're investing larger rounds at the Series A. So I'm going to talk about 3 main trends that I've seen that is driving all of this change in the seed space: the micro VCs, the accelerators, and crowdfunding. So micro VCs, what are they? They're actually funds that are less than 100 million USD, euro, sterling. About 5 years ago, you probably had about 40 of those funds around. Today, you have more than 200 of those funds around. The speciality of those funds is that they typically are smaller, they invest earlier, and in fact, they have a pretty good return on investment, an internal return on investment. But the question we're going to ask is, are there too many of them in the market? Are we going to see a little bit of correction at the early stages and less of these micro VC funds being created? The next is all around accelerators. There's two big debates happening with accelerators. The first is, are there too many of them? And the second is, are they any good? It surprised me, but only 0.2% of startups worldwide are accelerated. And in fact, if you have more and more companies being created, that tells me that there might be a market to create more accelerators. It was suggested in a talk earlier that maybe Malta might want to have a few accelerators of itself. The other interesting thing about this accelerator market is actually the corporate participation in this specific space. In the last 5 years or so, we've seen an explosion of corporates entering into the market. And what they're promising is they're promising a network, they're promising a network of mentors, they're promising access to their experts in their companies, they're promising space even. And some traditional VCs are arguing that maybe they're taking far too much equity than the value that they provide. The final trend that we've been seeing is actually in the crowdfunding market. What I found the most fascinating, and there are 2 points that I want to highlight here, is that there are different aspects in the funding curve that crowdfunding are impacting. The first is, it's more to do with angels. They're replacing the access to angels. I've not seen how they're going to impact later on in the funding curve, especially when you have 20, 30, 40 million rounds. The other two aspects are to do with lending and social capital. Two areas where the current market here in Europe isn't very strong at addressing. I find this figure fascinating. In the crowdfunding market, 73% is actually related to lending. And what we see on the social capital side is that it's almost 20% that is to do with good causes. So the big question is, what's next for the industry? What are we going to see in the next 5 to 10 years? I believe that the venture capital industry is ripe for reinvention. I think what we're going to see is the little bit of disruption that we're seeing in seed, we're going to start seeing later on in the curve. We're going to have more competition amongst venture capital firms, which means that they'll need to understand what their value add is to limited partners, understand what their value add is to entrepreneurs like yourselves, and they're going to start specializing into specific categories. For instance, space might be a category that might be interesting to start investing into. The second thing that I think is really interesting is about technical enablement. A lot of VC funds still run in these small teams. They typically have anything from 10 to 50 people in them, unless you're Andreessen Horowitz and you have more than a $7 billion fund, which means that you can take a big management fee. That's 2% of that you can have to run your fund every year. And so you can hire a whole range of people. In terms of technical enablement, you have CRM systems, customer relationship management systems, where you can track all your deal flow. You have platforms like Mattermark in the US, where you can filter deals and check out competitors. I'm not entirely sure if we will be seeing an artificial intelligence venture capital firm emerging. There is a firm in Hong Kong which is using artificial intelligence and algorithms in order to make investing happen. Maybe that's a trend that we'll see in the next 5 to 10 years. We'll also see diversity is a big, big topic in tech right now. We see a lot of funds looking to change up who is sitting within them. In the US, for instance, only 6% of the venture capital community are women. As there are more founders and diverse founders entering into the market, we'll probably see the same movements and changes in the venture capital market. The next trend is all to do with limited partners. Limited partners are becoming far more sophisticated. 30 years ago, the market was very intransparent. They didn't know where to get deal flow from. And in fact, the internet has democratized that. It's made it easier for you to go online and find deals. What's difficult is actually understanding what to invest in at the right time, and then to follow through with the investments to raise the next round of financing and help those companies with strategic decisions. But we find that 30% of LPs are actually very comfortable and want to do direct investing. Strong corporate participation. We've seen this in lots and lots of markets. There's tons of new funds being released all the time. Access Strategic Partners, for example, in Paris, they have a new 250 million fund launched last year. Commerce Ventures in Germany, they had a 100 million fund last year. Kellogg just announced a 100 million fund to invest in food last week. So we're going to see more and more corporate participation, especially because tech is being embedded into venture capital funds, and it's no longer, tech is being embedded into corporations, and it's no longer just a separate department. We're also going to see new models of VC funds emerging. There are that 2+20 model, the unscalable model that I described in the beginning. This is not going to be the norm going forward. I'm actually going to give you a couple of examples of new fund models that are emerging if you're interested. There is a fund in London, for instance, which is charging no fee whatsoever. So no 2%, they're literally going to be paid on their performance. So they'll take 20 to 25% of carry. And the final trend is, of course, internationalization of VCs. For the first time, we are traveling more than we've ever done before. I'm here in Malta. It's a great experience to be here because great companies can be built absolutely anywhere. So these are the big, I would say, themes that are happening in the industry. And here's a couple of examples of how they're being implemented. The big trend right now, and it's pretty much championed by Rocket Internet based in Berlin, is having something called a startup studio. It's a little bit counterintuitive to the traditional fund model because what it assumes is you have a group of people who are very smart. You have marketers, you have designers, programmers, etc. You pull them together, and instead of them working on a single business idea, they work on many business ideas simultaneously. And then once you've got the idea that you want, that members of that team want to start working on, you then fund it, and you might co-invest with other traditional VCs. We've seen this model emerging in Germany last year. FinLeap was a specific startup studio plus fund that emerged in Germany, and then in the UK we've got Founders Factory, which was actually launched by my old boss Brent Hoberman, who's the founder of lastminute.com, and I can skip that. Thank you.